Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, hear about their lessons learned through their career investing, what formative experiences shaped them into the investor that they are, and what they're thinking and seeing about the current market environment. I sat down recently at the MoneyShow in Orlando with Jonathan Hoenig. Jonathan is the founder of the Capitalist Pig Asset Management, was a hedge fund, now transitioned into an advisory service. We talked about Jonathan's experience launching the fund, transitioning the structure of it, but really a lot more about classic analysis of price behavior. Jonathan got his start in the financial industry on the floor of the Chicago Board of Trade, and like a true Chicagoan, blue collar, floor trader type. Jonathan still to this day thinks about price as primary. So please enjoy this episode with Jonathan Hoenig of Capitalist Pig Asset Management. All right, super excited to be sitting down with Jonathan Hoenig. Jonathan is with Capitalist Pig Asset Management. So if you forgive me, Jonathan, I'd love to start there. The name is intriguing. It draws you in immediately. What is the origin of that name? Why did that speak to you?
Well, I was in college at the time, and I had really gotten interested in investing, and the markets were really starting to go up at that time. And I started a radio show at my college radio station, and we needed a catchy name for the show. So it's going to be Capitalist Pig, and I love it. It was, the whole idea was to kind of talk to young people about the importance of saving, the importance of investing, the importance of looking long term. And now, 25 years later, it's amazing how those mantras paid off. 100%. I mean, people who, dollar cost averaged into a mutual fund from 2000 on have made enormous returns.
Huge, yeah.
So it's, but that's where it started back in college. And kind of a cheeky way to look at finance, perhaps. But, where I'm from, Chicago is a capitalist town, Leo Malamed from the CME once said that we think Capitalist Pig is good. So I agree with Leo.
There's a blue collar vibe to the financial industry in Chicago for sure. Always has been, with people buying onto the exchanges and trading their own books. Talk to me about your formative years. You're on the Chicago Board of Trade, the CBOT at one point.
Yeah.
Talk to me about those early formative years on the exchanges. Any lessons that you took from that period that inform how you approach the markets today?
Well, growing up in Chicago in the 80s and 90s, traders were just everywhere. I mean, you'd walk around downtown and you'd see these swaths of men in these brightly
jackets.
Colored, exactly, the brightly colored jackets.
Yeah.
And of course, business was booming at those exchanges.
Huge.
At the time. I mean, those were the Bitcoin plays, if you will, of the day. Those were really hot places to be. So, and I had always been fascinated by it, by trade in particular. Not even necessarily the money involved, although that's interested me a lot, but just how did this all work? How did this what looked like complete commotion of phones going off and orders being able to come in, and what does it produce? One thing, price. Right?
Yeah.
One thing that's produced that price. So that always intrigued me, and I think even as a kid, I said, one day I've got to be involved in this. And I was.
When you think about your journey from that moment and your formative years to where you're at now with Capitalist Pig, now Asset Management, what are some early lessons learned, or can you share a mistake or some lesson when you look back and think, wow, that really helped me become a better investor today? What was a miss early on that you learned from?
Well, I mean, there's so many misses. I mean, truly. I mean,
pick maybe one or two.
Yeah, I mean, so many pain. Jesse Livermore has that great line about, the market taught me the game and it didn't spare the rod by teaching. And I feel like that very much. I mean, I wrote a book called Price is Primary, and I joked that it's cost me $1 million to write this book of all the lessons that I've made. But the one that always sticks in my mind that is pretty easy for, I think, anyone to understand is this notion of losers average losers. It's not even my line. It's it's Paul Tudor Jones's line.
Yes.
But how many times have you had that experience where, you buy it at 50 and you love it at 50, and then you love it at 48, and love it at 46, and love it at 44, and all of a sudden you've got a huge position in a weak stock, and that's not what you want.
Yeah.
So I'm from the Jesse Livermore school, if you will. I average up. I buy into strength. I'm looking for strong assets. But there was plenty of names where you thought, boy, it can't go any lower, and it does, and it did.
Yeah. I was taught price goes down for a reason. That's number one. And the other one is a Peter Lynch quote along the lines of what you said, talking about with a portfolio, if you sell your winners and average into your losers, you're basically watering your weeds and pulling your flowers. And you want to do the opposite, right?
So
water
true.
your flowers. I think that's a great way to think about it.
Water the winners, absolutely.
Yeah, nurture those.
And what's so interesting is that you don't need to be right every time. I mean, I'm on TV, and there's a sense of like, well, you were wrong on these 3 stocks, these 4 stocks. You only really need 1 or 2 or maybe 3 ideas a year, in my opinion, to make money on and to be able to do very, very well.
Yeah.
And so it's a different mindset. Most people just think of, 8 out of 10 of his picks were winners. He must be a good investor. It's very unlikely and converse what actually happens. A couple good
winners can make a huge difference, I would imagine, right?
Yeah.
Talk to me a little bit about process. You and I were speaking before we got started, just about process and discipline. Can you tell me a little bit about how would you describe your investment process? What's your general game plan of taking arguably a fire hose of data and information we have? How do you actually triangulate that into a position or into a thesis? What's that look like for you?
It's so interesting. I talked to a gentleman here at the Money Show. He said he subscribed to something on the order of $10,000 worth of different subscriptions.
Wow!
And to your point, I mean, there's not just information overload. It's there's and there's so many different opinions. So it's important, I think, to come up with your own philosophy, your own process. And mine has been born over many years, but mine is primarily technically based.
Okay.
When I look at an investment, I'm not looking at its business model necessarily. I'm not even looking at its earnings or its CEOs. I'm looking at its price and its price action, both by itself and also within its group or its sector. I'm trying to get a sense of what's going on in the market.
Yeah.
So, a lot of advisors, a lot of investors can tell you what's happening in the economy. They can tell you what's happening with government numbers, but what's happening with the price action of XYZ stock. And that's why something like, lately gold 4,000 has been, everyone said, gold 4,000. But this is a trend that's been under place for months. But, most people, price is the least the thing they're interested in. They want the story.
The narrative, right?
Exactly. But the price is telling you the narrative before you get the narrative.
Yeah, right.
So I'm a guy who looks at price. And I also like to find things that most people, when you say, I want to put money in this, they'd say, you're crazy. Things that are doing well that you'd say, the old saying, bull markets are built on doubt, bear markets are built on hope.
Yes.
So,
that's good. Yeah.
And Bitcoin's a great example of that too. I mean, Bitcoin was doubted from 2013, 14, 15, 16, 17, 18, for years. And now it's completely been embraced. It's no more doubted.
Yeah, let's go down that road a little bit more. I know you do a lot with alternative assets, just thinking about how that relates to other things. Talk to me about precious metals, about cryptocurrencies. How do you think of that as part of an overall allocation? How do you think investors should be thinking? Because I know a lot of investors still kind of skeptical of cryptocurrencies. It's a new area of the market. But how do you think about those alternatives, real estate and other things, relative to like a core equity position? What does that mean?
I think you have to cast a wide net. And it's a great opportunity to do so. I mean, thanks to, Wall Street gets a lot of bunk or gets a lot of hatred these days. But, the truth is they've made investing in so many different types of markets, so many alternatives that used to be inaccessible to everyday investors. Something as simple like, this isn't a recommendation, but like a covered call strategy.
Sure.
I mean, that used to be a fairly cumbersome thing. You were paying a lot of commissions at the time. You had to have a fairly big portfolio. Yeah. You could buy a covered call ETF and pay 30 basis points, pay almost in essentially nothing.
Yes.
So I think it's a great opportunity now. The indices have dominated for many, many years. Nothing to take away those who've benefited from that.
Yep.
But as I said, I wouldn't be surprised to see a period not unlike maybe 2001 to 2010 when the indices perhaps tread water.
Okay.
And a lot of those so-called alternatives, international, small cap, really took center stage.
Very, very interesting. I'm curious, you talked about covered call strategy, kind of a classic defensive strategy, right, to protect yourself a little bit. What does risk management mean, especially as a trend follower? You're following trends as long as they're working. How do you manage risk? What does that mean when you're allocating in a portfolio? How do you think about it?
Isn't it funny how people sneer at trend follower? Oh, you're just a trend follower. Like, you don't do
I don't say that, Jonathan.
Well, but you've heard that, right?
Oh, for sure.
But it's like, what am I supposed to be, a trend fighter? Does that make sense?
I don't think that works particularly
exactly.
well.
It's like people who will go out in the middle of a rain wearing a swimsuit just because they want it to be sunny. They believe it should be sunny.
Yeah.
You asked about risk management.
Yes.
There's a great saying, your first loss is your best loss.
Ooh, yeah.
And I joke that I'm a trader when I'm wrong and I'm an investor when I'm right.
Oh, it's good.
So I spend a lot of time trading away small, little losing trades.
Right.
And it's amazing what a relief it takes off your shoulders. That thing you were tossing and turning, maybe you were down 8%, 10%, 12%.
Yeah.
Taking that loss, taking that first initial loss.
Yeah.
It should be like taking out the garbage.
Right.
It's not like a character flaw of you that you were a little early. It doesn't mean you're a bad investor.
Yeah.
What makes you a bad investor, in my opinion, is when you stick with it, when you double down, when you start buying options on it, when you want to be proven right.
Yeah.
So now you're playing a different game than wanting to make money.
Yeah. Do you want to be right or make money? That's a good one.
And that's ultimately what it's about. The old Francis Bacon has the saying, nature to be commanded must be obeyed.
Right.
And the market is nature. It is going to do what it does, no matter what we think about it, how we're positioned.
Yeah.
So I don't fight the tape. I try my best to respect it.
Don't fight the tape.
Yeah.
So as a trend follower, we've got a lot of things in a lot of trend. We talked about gold, right, and pushing $4,100 an ounce. The S&P 500, a lot of AI trades doing particularly well. I mean, when you're thinking about stocks in particular, what's your confidence level of a continued uptrend versus seeing signs of a change in trend, and any specific tools or techniques you would use to try to identify, all right, this great bull market of 2025 is starting to change. What would that change of character look like in your process?
I start by oftentimes looking at 50-day highs.
Okay.
Something's going to be come to a 52-week high. A 52-week high.
Yeah.
It's going to make a yearly high. It's at least got to start with a 50-day high.
Right.
And oftentimes you see, I always joke, it's like summer really starts in the middle of winter. You slowly see the green shoots. And all of a sudden people say, hey, winter, that came so fast, but it didn't. It started,
It's gradual, right.
So I try to look at 50-day highs, and I'm looking for, this would surprise people if they knew that this was happening.
Yes.
Like, in fact, again, not a prognostication, but I happen to notice that Adobe, 1% weighting, I think in the triple Qs, this is not an insignificant stock, slipped to a 52-week low this last week. So I thought, I haven't seen that in quite a while.
Interesting.
So I do think we're seeing in equities a changing of the guard.
Yes.
The first half of the year, it was international that stole the show.
Yep.
The dollar has a lot to do with that.
Yep.
I'm not rooting, I'm just observing.
Yeah.
So lots of, I think, opportunities for people to make money in those areas that maybe haven't been so popular in many years.
Yeah. One of the issues we have with this market right now, a very over-concentrated benchmark, like a top-heavy benchmark, right? So the top 10 stocks are about the same weight as the bottom 450 in the S&P 500. How do you deal with that over-concentration and the fact that a small number of huge names have such an outsized weight? Does that change the way you think about positioning? How do you think about sort of the other 490 stocks outside of that top 10? You know what I mean?
I think it's very important, but people look at you and sneer, and they say that's indexing and over the long term, and that works.
Yeah.
But it's almost a little bit deceptive to say you're diversified when you own the S&P 500, because as you said, you've got it's not a majority, but it's a big chunk of that focused not even just on 10 names, but on one or two ideas.
True. Yeah.
And I remember in 2000, it became very much the same with Cisco and Intel and Oracle and CMGI and Nortel. These were big parts of the indices.
Sure.
And so to me, it's probably one sign of a late stage bull market is when you get to have that concentration.
Yes.
Again, I'm not a bear, but AI is the story is out. This is no one. This is not news to anyone now.
Yeah.
In fact, we're starting to see more and more Fortune 500 companies integrate the technology.
Yeah.
And if it's anything like the internet was, I was joking. I say, Cisco was going to be Cisco Systems. Remember?
Yes.
In the 90s, this was the stock to own.
Yes.
They were the future. If the internet succeeds, Cisco's going to.
This is it. Yep.
Right.
Yep.
And here we are. Right. The internet did succeed.
Yes.
And Cisco is trading below where it did in 1999.
Yeah.
Pretty amazing.
There's always this big disconnect, I feel, at times with themes that we even know for sure are going to work versus what companies and what stocks are actually going to benefit from that. I'm curious, to digress a bit, how has AI impacted your own process? Do you use any AI-related tools, or has that made any meaningful change in your own process of identifying ideas and managing risk and all of those things, or not so much yet?
I have to say, not so much.
Okay.
I'm from the school that says there's almost nothing new under the sun.
Right. Okay.
That it comes down to taking losses, letting winners run.
Yes.
And, having the discipline to do that over and over and over again,
yes.
which for many people is very difficult.
Yeah.
I always say the shorter the time horizon, the more difficult it is to make money.
Yeah.
So I try to encourage people to have that long-term time horizon. You want to, as you pointed out, you don't want to sell it for a 7 or an 8 or a 10% gain.
Yeah.
You want to hold something for a 40, 80, 90, 100% gain, and that happens all the time.
Yes.
It really does. When a bull market takes off,
yeah.
I talked about platinum at the Money Show about a year ago. It took off and it continues to move. So the hardest thing, Jesse Livermore also talks about how it's difficult to find people who can be right and to sit on their hands. And it's so difficult.
It's true.
But to sit on a winner is how you really make money.
Yeah.
Be able to sit on that open winning trade.
I love the Jesse Livermore quotes. Thanks so much for peppering those in. And I think you're right. There's no sadder investor I've ever met than someone who sold when something was up like 20, 30% and then sat on the sidelines as it went up another 200, 300%. There's nothing worse than something like that.
It's always a belly flop.
Yeah.
You have to let ourselves off the hook.
Yes.
No one buys the bottom and sells the top.
Yeah.
But that's why I do think, and the book is called Price is Primary, but it's really about giving you a trading strategy, giving you a trading philosophy.
Yeah.
And just the idea of let's say people get stopped out.
Yeah.
You buy it at 50, you get stopped out at 40. You buy it at 50, you get stopped out at 40. Well, let's say it's back up at 50 now. For me, I'm buying it again.
Yeah.
Because you know what? I'm in it for more than just 20 points anyway.
Yeah,
I'm in it for 50 points.
Yeah.
So sometimes we're not wrong. We're just early.
Yeah, right.
And let yourself off the hook.
I like that. Be patient. Tell me this. So in the last year or so, you've transitioned Capitalist Pig from a hedge fund structure to more of an asset management structure.
Yes.
Talk to me about that transition and how are you approaching things now? A little more attuned to, I would say, individual investors and what they might be doing would be my guess. But talk about that strategy. What does that mean for your day to day and how you're approaching the market?
Well, I have to say, the hedge fund industry, in my experience, really changed after the Bernie Madoff scandal.
Sure. Okay.
Whereas once ambitious investors were very happy to send a new young emerging manager money, they became very concerned for absolutely good reason.
Yeah.
More and more investors wanted their accounts in their name at their brokerage.
Yeah.
So the trend itself is working that way. Even better is that so many of the strategies that used to only really be able to be accomplished in a hedge fund environment are now really readily available.
Yeah.
To everyday investors. We talk about some of those ETFs.
Yeah.
So I'm bringing the same kind of an absolute return, alternatives-focused strategy to individual accounts.
I love it.
And I read a stat, something on the order of 1 in 5 Americans are millionaires now.
Wow.
So there's a lot of money that needs prudent management.
People need help.
Yeah.
With that in mind, we're here at the Money Show in Orlando. There's a lot of individual investors running around here and attending events and asking a lot of good questions. What's the mistake or the shortcoming do you feel like a lot of individual investors make? What decision do you wish that they would improve on or that you hope that they could do better?
Well, here's one that people never think about.
Okay.
And what size position do you buy?
Yeah.
Right?
So underappreciated, right?
But that's really what makes the difference.
Huge.
Because what happens is this XYZ they really like. Yeah. So they put 10 grand in that. And ABC, oh, well, we'll just put $100 in that.
Yep.
And ABC goes up 400%. And what they thought was the sure thing underperforms.
Right.
So I talk about it in prices primary. I think the answer is you standardize your initial position size based on your overall number of assets.
Yes.
So if you got 100,000, you say every new trade I'm going to start with a 2% position.
Yeah.
And no matter whether it's something I really like or whether it's something that's very speculative or not, I'm always going to start with that 2%. And if you can cut the losers at 8, 10, 15, 20, 22, you're going to have a couple of 100% winners in there.
Yeah.
But consistent position size. It actually also takes a lot of the anxiety off.
100%.
Because it's like, oh, I like it. Well, what do I do? Do I buy 1,000 shares, 100 shares?
Yeah.
Pick a position size that's a percentage of your overall assets and stick with it.
Yes. I love that comment. There's a Price Headley is at bigtrends.com. I've interviewed him before, and he said, if you're having trouble sleeping at night, your position size is too big.
Yes.
Along the lines of what you said.
Yes, J.P. Morgan. He stole that from J.P. Morgan.
It's
right.
beautiful.
Sell to the sleeping point.
That's
but
right.
It helps give you a sense of, all right, what I like it. Where should I start?
Yes.
Consistent position size.
I love it. Jonathan, your book is called Price is Primary. Thanks for highlighting that. And I would agree, price is indeed primary. So I'm sure people listening and watching got that from our conversation today. Thanks for sitting down with us. Enjoy the rest of the show.
Pleasure.
Safe trip home.
My pleasure. Thank you.
Yep. Thanks, Jonathan.
Oh, I really enjoyed it.
Thank you. Jonathan's session at the Money Show last week was called Price, Principles, and Profits. And I think you sort of got all three of those when we talked, in that interview. I really love, when I talk about sort of the stereotypical Chicago floor trader, like the CME, the SIBO, the Board of Trade. He shared the story about walking around downtown Chicago, seeing all the guys in their colored vests going out for lunch. I remember days early in my career in the early 2000s, in the Loop, walking around the Board of Trade and other exchanges, seeing the guys walking around just completely intrigued by what they were doing. And when you meet them on the floor and look at how they approach the markets, it was all about price. And so, me as a technical analyst, Chicago, and meeting with Chicagoans and talking with floor traders felt like kindred spirits. And I sort of got that vibe talking with Jonathan. We talked about trend following principles. We talked about the importance of price over everything, how price trumps valuations, trumps fundamentals, trumps macroeconomic issues. And while, again, all of those granted are still part of the picture, they're still, they still have value. Price is primary. And I really loved our discussion about sort of the mental game of trading and how a consistent process of analyzing price, in my opinion, best described as technical analysis, can help you be a well-rounded trader, a well-rounded investor, certainly a more mindful investor. Thanks again to Jonathan Hoenig joining us from the Money Show in Orlando. I hope you enjoyed that conversation. Hey, we're always looking for others to sit down with virtually or at an event. So if there's any that you any guests that you think would be great on the podcast, please drop a comment wherever you're seeing this and let me know. By the way, if you want to learn more about some of the tools and techniques we use every trading day to analyze price and follow the message the markets provide back to us in the form of price action, our Market Misbehavior Premium memberships may be a great opportunity to upgrade your own decision-making process. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where we'll teach you what happens between your ears. That's called behavioral finance. And we'll share with you a set of tools and techniques to use every day. That's called technical analysis. Second, you'll have access to all of our member-only reports like our weekly flight plan, our monthly chart review, and others where we apply our own proprietary use of technical analysis to better understand the world around us, identify opportunities, and manage risk. Finally, you'll have full and immediate access to our member community where you can ask questions, you can learn from other premium members, and go through these markets with a group of like-minded investors and people pursuing mindfulness in their own decision making. If you want to learn more, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.